Hello everyone, welcome to the 169th episode of me learning how to trade in Forex. So in the last episode we went through using moving averages, basically how we can interpret moving averages and both simple and exponential moving averages and forecast market behavior. So we could derive a trend direction using moving averages. So generally in an uptrend, the shorter period or the faster moving average will remain above the longer period or the slower moving average. So for example, in this example here, we've got the 10 period moving average is going to be higher or above the 50 period moving average. So that means that 10 period is faster than the 50. And then in a descending trend, the opposite is true, so the slower moving average is going to be on top of the faster moving average. So the 50 period exponential moving average is going to be above the 10 period exponential moving average. And we've got moving average crossovers, so this is where we can see like a change in the trend direction if either the slower one or the fast one crosses over the other one. So over here, the 10 moving average is usually above the 20 moving average in an uptrend, but below it in a downtrend. So we can see somewhere over here it starts to cross. So the 20 moving average is going to go above the 10 moving average. So that means there could be a reverse in the trend. So going from an uptrend to a downtrend. And then we could also use moving averages as support and resistance levels. So if we do plot the 10 exponential moving average here, we can see it's kind of resistance level, So the price doesn't normally break through it that much, but there are some areas where it does break through over here. But if we put a longer period exponential moving average, so 50, then we can see that it's not really a real breakout, it's just a fake out basically. So yeah, that's that. And then we went through a lesson summary. And now we're on using moving averages. We were on using moving averages. Whoops. Now we're on choosing your analysis tools. Right. Okay. So yeah, just to make sure. So choosing your analysis tools. Choosing your analysis tools. So dated the 17th. Alright. Now that we've explored some of the key tools and techniques frequently used by technical analysts, let's finish by considering how you should go about choosing which ones to use in your own trading. Which moving averages should I use? As we saw in the last section, using several moving averages at once can provide all manner of trading signals. So it's important you choose the right ones to suit the situation and your trading style. Remember that shorter period, faster moving averages stick closer to the price, so you are more likely to catch trends or reversals early, though you're also more likely to get caught out by false signals and fake outs. So shorter periods, faster moving averages stick to the price. Stick closer to the price, stick closer to the price, so you're more likely to catch trends and or reversals early. Trends or reversals early. However, you're also more likely to get caught out by false signals and fake outs. However, you're also more likely to be caught out by false signals and fake outs. Similarly, exponential moving averages give more weight to recent price movements than the simple moving averages, so tend to react more quickly to price moves, they are also more vulnerable to short-term price spikes. Exponential moving averages give more weight to recent price movements. Give more weight to recent price movements than simple moving averages. So tend to react more quickly to price moves. So tend to react more quickly to price moves. However, they're also vulnerable to short-term price spikes. However, you're also more likely to be affected by short-term price spikes. The best way to trade with moving averages is to experiment yourself with different speeds and find the ones that work for you. Based on the types of signal you're looking for and whether you're trading over the short or long term. However, it's sensible to start off by looking at the most popular periods because the more traders that are using these levels, the more likely they are to become self-fulfilling. It's sensible to start off using the most popular moving average periods as lots of traders use them as well. Therefore, they're more likely to become self-fulfilling. It's a horrible way to start self-fulfilling. Like that, yep. So I think when they say self-fulfilling, they mean like the support and resistance level could actually become the support and resistance level because so many people are using it and there's lots of people thinking it is, then it could actually happen. So yeah. For example, if enough traders believe an asset's 50-day simple moving average will turn out to be a strong resistance level and decide to sell when the market reaches it, then the price will indeed be forced down because of that selling pressure. Yep. The most popular moving average periods are days, 5 days, 10 days, 20 days, 50 days, shorter term traders, 50 days, 100, 200, longer term traders. Right, okay, so the most popular moving average periods are, because you can do hours as well, can't you? So or is hour too affected by price movements, price spikes? Putting it all together, in this basic introduction to technical analysis, we've gone through a fair number of chart patterns, candlestick patterns, and looked at one technical indicator in depth. Even with this limited knowledge of the subject, you can start finding a large number of trading signals on pretty much any chart you care to look at. And yet, this is barely scratching the surface of the number of techniques and indicators available. So how do you select the best ones to use? As we've touched on earlier, no indicator, pattern, or technique is right all the time. False signals are thrown up constantly, so the best way to use technical analysis is try to identify when you can trust a signal and when and why false signals appear. Best way to use technical analysis is to identify when you can trust a signal and when and why false signals appear. You can do this by studying how the market tends to react in different situations and by combining techniques like trend analysis with moving averages, chart patterns, and other indicators. Studying how the market tends to react in different situations. Our market tends to react in different situations. Study how the market tends to react in different situations. The more techniques you know, the more you can draw on to help inform your trading strategies, though it's by no means necessary to know how to use every major indicator out there. It's really all down to you and how you like to trade. Some traders only use support and resistance levels, for example, while others combine a large number of complex indicators. The only true way to learn is to try it for yourself and see what works for you, though we'd recommend practicing these techniques on a demo platform first. Yep. So let's do a summary. Moving averages, simple moving averages, and exponential moving averages can be useful on their own, but they can be even more powerful when combined with each other, or with other technical analysis techniques. Remember that no technical indicator, pattern, or technique will be accurate all the time. Be wary of false signals. Rather than trying to master every available technical indicator, take your time exploring ways of using different analysis tools to help define what works for you. Okay. Quiz time. Which type of chart is generally considered to give the clearest and most detailed view of the market movements and trends? Candlestick. When a market price tends to bounce back every time it drops to a particular level, that level is known as bounce back support, so it bounces up again. What does the size of a candlestick's body signify? The market's open-close range, because the wicks is the high and low range. When the market touches support resistance and then reverses, this is known as a touches and then reverses, testing the level. If you draw a trend line, how many peaks or troughs do you need to confirm the trend? 3. Which pattern is just completed here? Where? I can't see anything. Which of the following chart patterns signify that the market may soon take a downturn? Right, okay. It's definitely not the rectangle, because that forms during a consolidation period, and it would continue the trend of whatever it was that was before the consolidation period. So not that. Bearish engulfing, rising wedge, falling wedge. It can't be both wedges, so it's got to be one of the wedge. Let's go falling wedge, because falling down. Tweezer tops or tweezer tops is the one that has a body like that and then the wick shooting upwards. So that means does that signify downtrends? Bearish engulfing, that's definitely going down. Tweezer tops, that signify a downtrend. Trying to think if tweezer tops is green or red. I don't think the colour matters for the tweezer tops. So, but the low, there's barely any low price. So the low is pretty much either the opening or the closing price. Yeah, let's go tweezer tops. I think that's a reversal pattern. Doji is a candle with almost no body at all, formed when opening and closing prices are nearly identical. True, because it signifies indecision in the market. If the market is in an uptrend, which of these moving averages would you expect to see appearing above the others on the chart? Uptrend, the faster ones come top, so 10. What does a moving average crossover generally signify? Trend reversing. Okay, so candlestick charts are the most popular of traders because they convey a large amount of data in a visually pleasing, easily digestible format. It's often easier to spot patterns and trends with this type of chart. Okay, that's good. Support level is like a glass floor, while resistance is like a glass ceiling, appearing to limit a market's range of movement. The body of the candle represents the range between the opening and closing prices, whilst the wick shows the high and low points reached. Yep. If the market briefly touches or jumps through a level and then immediately reverses, it is said to be testing the level. If it passes through support resistance and keeps going, that's a breakout. However, if the breakout isn't sustained and the price reverses again, it's a fake out. You only need to connect two major peaks or troughs to draw a trend line, however a third is needed to confirm the trend. Right, okay. Yeah, I think there's meant to be a diagram here, but there isn't. So when a market rises to three successful peaks, second being the highest, then drops below the neckline of the two troughs between them, a head and shoulders pattern is said to be complete. Okay. It's meant to be rising wedge, right, okay. A rising wedge formation, bearish engulfing, and tweezer tops candlestick patterns all suggest the price could soon move lower. A rectangle indicates a consolidation period where the market is likely to continue in the same direction, while a falling wedge is a bullish pattern implying a possible rise. Oh, right, okay. So doji occurs when the opening and closing prices are extremely close together, shrinking the candle's body. The wicks can be any length in either direction. Doji often signifies indecision or consolidation before a trend reverses. Yep. Longer period moving averages are slower and smoother, lagging further behind the current price. In this example, the 10 simple moving average is the shortest period. It should therefore follow the price most closely and be the highest of the three moving averages on the chart. If the market was in a downtrend, the 10 simple moving average would be normally the lowest, however. So shorter moving averages usually follow the current price closely, while longer moving averages lag behind. When the lines cross over, this implies that the market may be about to change direction. Cool. So I think that's the basics of technical analysis done. Yep. So that's good. Now we're on to fundamental analysis. It's a question that intrigues every trader. How can I find the hidden trading opportunity? Identifying a little known stock that's about to soar, perhaps even the Apple or Google of the future, is an investor's dream. Fundamental analysis can help you in your search. In this course, we'll explain how you can apply its methods to drill down through layers of information and uncover the markets with potential value that others may not have spotted. You'll learn how to evaluate economic data, scrutinize company financial reports and earnings, interrogate management teams. This will help you discover which shares could be poised for growth and which may be headed for a fall. Nice, so, start course. What is fundamental analysis? What is fundamental analysis? Fundamental analysis is based on the notion that every asset has real fair value. However, in certain times, for example when traders have not yet taken into account of new factors affecting this value, the market may not necessarily reflect the asset's true worth. This results in the price being higher or lower than it really should be. If you can identify when an asset is trading at a price that differs from its real value, you may have an opportunity to profit. Fundamental analysis is based on the notion that every asset has a real fair value. Did not know that. That's because in these circumstances, fundamental analysts believe the price will tend to naturally correct over time, gravitating towards its real fair value. So in fundamental analysis, your aim is to discover assets that are currently underpriced or overpriced, then place trades to capitalize on their potential movements as the value corrects. Fundamental analysis is based on the notion that every asset has a real fair value. However, at certain times, the market may not necessarily reflect the asset's true worth. This results in the price being higher or lower than it should be. This results in the asset's price being higher or lower than it should be. That's because in these circumstances, fundamental analysts believe the price will tend to naturally correct over time. Fundamental analysts believe that the price will naturally tend to correct itself over time. Gravitating towards its real fair value. And gravitate itself towards its real fair value. So in fundamental analysis, you aim to discover assets that are currently underpriced or overpriced, then place trades, capitalize on their potential movements as the value corrects. Buy before price corrects, so the current price, and it rises to the true value. So your aim is to discover assets that are currently over or underpriced and place trades to capitalize on the potential movements as the value corrects itself over time. To illustrate how this works, imagine you see an attractive house for sale in an unpopular, rundown area. Suppose you do some research and discover the district is soon to undergo a major regeneration project. You might be able to buy the property at low cost, then benefit as buyers start to recognize its value, driving up the price. A fundamental analyst might do something similar by buying financial assets that have hidden potential, particularly company shares, which will focus on this course. How does this differ from technical analysis? While both technical and fundamental analysis involve using information that's available now to predict how a market might behave in the future, they do this in different ways. When you conduct technical analysis, you focus exclusively on price data and movements, seeking trends and patterns that indicate the likely future direction of a market. In fundamental analysis, on the other hand, you take a more holistic view and consider all the circumstances surrounding the market. You might evaluate the general health and well-being of the entire economy, industries within that economy, and individual companies that make up an industry. This could include assessing all kinds of factors, from a whole country's employment rates or manufacturing output right down to an individual company's cash flow and expenditure. Fundamental analysis is often said to be more rigorous and comprehensive than technical analysis because everything that can affect the asset's value is studied and taken into consideration, not just price data and chart patterns. In practice, although you may hear people advocating the use of one form of analysis over the other, it's normally wise to combine elements from both types if you want the fullest and most accurate picture of a market's likely behavior. Fundamental analysis analysis takes into account everything that can affect the asset's value. That can affect an asset's value. In practice, although you may hear people advocating the use of one form of analysis over the other, it's normally wise to combine elements from both types if you want the fullest and most accurate picture of a market's likely behavior. Yep, okay. Lesson summary. Fundamental analysis is based on the notion that every asset has a real fair value towards which its price will gravitate. Analysts aim to discover assets that are currently underpriced or overpriced, then place trades to capitalize on the potential movements. Unlike technical analysis, fundamental analysis takes a holistic view of all the circumstances surrounding a market. So how does fundamental analysis work? How does fundamental analysis work? Rather than having one prescribed universal method, fundamental analysis can be conducted in a number of ways. However, many analysts tend to use a top-down approach. This begins by considering the wider picture before progressively drilling down into the details surrounding each market. Fundamental analysts use a top-down approach. So look at the wider ones, considering, so this considers the wider picture before progressively drilling down into the detail surrounding each market. So the big economies, the sectors within that economy, and the companies within that sector. Let's look at how you might do this. Suppose you're thinking of trading on UK shares. Here are some steps you could follow to analyse the market for potential opportunities. Consider overall economic performance. What is the state of the UK economy generally? If an economy is in expansion, it's reasonable to suppose that the industries and companies within the country will benefit and see growth in turn. Conversely, if an economy is declining, then even successful businesses might suffer. To determine this, you could look at the macroeconomic data such as GDP figures, manufacturing output, the consumer price index, CPI, retail sales, house price indices, or employment statistics. And of course, you should also consider news coverage and political rhetoric, even if sometimes it has to be taken with a large pinch of salt. So consider the overall economic performance. Consider the overall economic performance. So steps to analyze the market for potential opportunities. Consider the overall economic performance. What is the state? How is the state of the country's economy generally? So if the economy is in expansion, it's reasonable to suppose that the industries and companies within the country will benefit and see growth in return. Conversely, if the economy is declining, then even successful businesses might suffer. If the economy is declining, even successful businesses might suffer. Note to self, look up all the potential factors that indicate a country's overall economic performance. So macroeconomic data, there must be more factors than this which helps you determine how good an economy a country has. So I need to look up more factors which represent the state of a country's economy. There we go. Look at macroeconomic data. Look at macroeconomic data to determine this. E.g., GDP figures, manufacturing output, CPI, retail sales, house price indices, or employment statistics. Consider news coverages as well. Assess which sectors will be affected. How will macroeconomic factors influence different types of business? How will the macroeconomic factors influence different types of businesses? When an economy as a whole is expanding, certain industries may benefit more than others. For example, when consumers have more money in their pockets, the services industry tends to enjoy the effects of their increased spending. On the other hand, utilities business will usually be largely unaffected. There can also be times when economic expansion has a universally beneficial effect that is felt by most sectors and companies. In this situation, the overall risk in equities could be relatively low and it might be worth considering a strategy geared towards growth. For example, you could focus on a sector such as technology or biotech, as these tend to have high potential for rapid expansion when conditions are favourable. On the other hand, if an economy is expected to shrink, you might decide on a conservative approach, investing in stable companies that are geared towards income. An example would be buying energy or utility stocks. Alternatively, you could aim to capitalize on an expected fall in the markets by going short, a concept we covered in How Trading Works course. In brief, this traditionally involves borrowing a stock with the intention of selling it and then buying back at a lower price. A more accessible way to make this we take a short position is via spread bet, UK and Ireland only, or CFD trade, contract for differences trade, as we explained in the spread betting and CFDs course. Certain industries may benefit more than others when the economy is expanding, i.e. when consumers have more money in their pockets. The services industry tends to enjoy the effects of their spending. Utilities business will usually be largely unaffected. So there can also be times when economic expansion has a universally beneficial effect that is felt by most sectors and companies. There can also be times when economic expansion has a universally beneficial effect that is felt by most sectors and companies. Gearing a strategy geared for growth. Therefore, it might be worth considering a investment strategy geared for growth, e.g. technology and biotech. On the other hand, if an economy is expecting to shrink, you might decide on a conservative approach. However, if the economy is expected to shrink, a conservative approach might be better. Such as investing in stable companies that are geared towards income, e.g. energy or utilities stocks. Alternatively, you could aim to capitalize on an expected fall in the markets by going short. You could also go short to capitalize on an expected fall in the markets. Yep. Select a sector to focus on. Select a sector to focus on. Which sector has the greatest potential? Which sector has the greatest potential? Having identified some industry sectors of interest, the next step is to consider levels of supply and demand for the product or services in each, and the other factors affecting their future prospects. You could look at the size of the market, its overall growth rate, and the sector's significance in the economy as a whole. For example, let's take the electricity component of the utility sector. The size of this market in the UK is linked to the size of the population, so it will grow as the number of people consuming energy increases. The sector will always be supported by a certain level of demand for electricity to power everyday activities. However, this can also be increased or decreased by the rollout of new technologies, so it's worth considering what innovations might soon hit the mass market. By contrast, the mining sector tends to have a much more variable growth rate, tied to the cost of extracting raw materials from the earth. While new discoveries can provide a significant boost, the sector can also be hit by fluctuations in global demand. Events like a slowdown in China's economy can reduce consumption of raw materials for construction, impacting mining industries. In the stock market, it's typical to see a particular groups of shares moving together in the same direction like this. So for that reason, it can be more important to choose the right industry to trade on rather than simply the right company's share. Right, okay, so consider levels of supply and demand for the products or services in each, and the other factors affecting their future prospects, and the other factors affecting their future prospects. You could look at the size of the market, its overall growth rate, and the sector's significance in the economy as a whole. The size of the market, its overall growth rate, and the sector's significance in the economy as a whole can be looked at. For example, let's take the electricity component of the utility sector. So, you know what, before this, I think I should look at all the available sectors in an economy. So there's the utilities, I guess services is another sector. I think I saw services, or services industry, does that count as a sector as well? Services, technology sector, energy sector, that sort of thing. So work out what available sectors there are in an economy. Note to self. Right, okay. So let's look at the electricity component. The size of this market is linked to the size of the population, so it will grow as the number of people consuming energy increases. The sector will always be supported by a certain level of demand for electricity to power everyday activities. However, this can also be increased or decreased by the rollout of new technologies, so it's worth considering what innovations might soon hit the mass market. By contrast, the mining sector tends to have a much more variable growth rate, tied to the cost of extracting raw materials from the earth. Yeah, while new discoveries can provide a significant boost, the sector can also be hit by fluctuations in global demand. Events like a slowdown in China's economy can reduce consumption of raw materials for construction, impacting mining companies. In the stock market, it's typical to see particular groups of shares moving together in the same direction like this. So for that reason, it might be more important to choose the right industry to trade on rather than simply the right company's share. So within the same utility sector, right, could gas affect electricity somehow? Or is gas energy? I don't know actually. I need to look that up. So within the same sector, could they have an impact on each other as well? Don't know. Going to actually look. Gonna need to have to do some reading on that. So yeah, the stock market, it's typical to see groups of shares moving together in the same direction like this. So the stock market, particular groups of shares can move together in the same direction due to links between them. So for that reason, it can be more important to choose the right industry to trade on rather than simply the right company share. Choosing the right industry to trade on. Choosing the right industry to trade on more important than choosing the right company. Cool. I think I'm going to leave this one here for today actually. So I know there's a little bit left, but I have to leave that for the next video. So yeah, so thank you all for watching, and in the next video we're going to start off by finishing off the little section which we left behind, and then move on to analysing an individual company. So thank you all for watching, and I'll see you guys in the next video. Bye bye.